Hi, and welcome to this week's look back at the major stories that have affected the market so far. And an interesting one we're going to start with, and that's the Great British Pound, and the fact that the pound remains the best performing G10 currency in 2023. Now, 2022, especially the end of it, was a depressing time for the pound. Obviously, massively high levels of inflation, impact of Brexit still being felt, lockdowns were all taking their toll. And this was a time whilst the US economy continued to recover and remain steady, with inflation seemingly under control and the Fed now beginning to discuss the possibility of not making further interest rate hikes. The UK still completely dogged by those factors. But surprisingly, data this week shows the pound is the best performing G10 currency in 2023. There's still a degree of caution from analysts about it, but the pound is in fact up over 3% versus the dollar so far this year. And the UK is currently avoiding recession, that's to use the Chancellor's term. Despite flat growth last month, it's actually up 0.1% in the first quarter of 2023. Now, households are still affected by the cost of living crisis, and spending still seems to be quite cautious and muted. The overall UK fiscal position has improved since 2021, which may well be a contributory factor. There's no geopolitical unrest that we've seen, such as in France or Israel, for example. Pretty much the UK public getting on with it, though it's worth saying that the strikes that we've been seeing have had an impact, and again were quoted in terms of the flat growth in GDP for last month. Certainly the short-term prime ministership of Liz Truss and her perceived ruinous mini-budget seem to be a distant memory. So things are looking quite rosy for the pound currently. Let's see how long that will continue for. Okay, second up, we're going to have a look at the US dollar. They're effectively Q1 results, if you like. The first quarter actually quite disappointing for the US dollar index. We've already mentioned sterling up 3% against the US dollar. If we have a quick look at the chart, the price of dollar index futures made a false bearish breakout, that's 0.1 of range A. Then after an uptrend, a false bullish breakout, 0.2 of range B, which formed, and the price entered a downtrend. March saw the price break through the 103.1 support level, which is now resistance, and approached the 101.5 support, which was evident through January. What's happened there? Well, the possibilities include obviously the Fed's policy of fighting inflation, the banking crisis that we saw, and the deposit outflows. And also there is talk as the potential de-dollarization having effect. We've seen China agree to abandon US dollar settlements for trade with Brazil and Russia, and obviously quite a lot in the news about that at the moment. The decline in the intrinsic value of the dollar in March was clear to see, and certainly seemed though to contribute to growth in dollar denominated assets. So not all negative. The Nasdaq up 14% in Q1 and gold up almost 9%. So we're talking about rosy sterling, not a great first quarter for the dollar, but obviously does have positives elsewhere. Is that going to change? Well, we'll come on to that in a moment. Okay, third up. So despite just talking about a pretty poor Q1 for the dollar index, let's have a look at the dollar against yen, and are bulls trying to revive the long-term trend? Well, dollar yen reached several week highs earlier this week, and that was facilitated, we think, by the statement by the new head of the Bank of Japan, Kazuo Ueda, who made it clear there's no need to rush to curtail the stimulus policy they use. Also, we had Friday's US employment report, which may impact expectations of a May interest rate hike. Well, unemployment is down to 3.5% in the States. And in fact, we saw a bullish gap on Tuesday when the dollar index futures market opened. US commercial bank deposits, which we spoke about having possibly a negative effect in Q1, rose towards the end of March for the first time in over a month. Is the bank crisis abated? Is that going to lend a bit of support now to the US dollar? If we have a quick look at the dollar yen weekly chart, it may give the idea that the bulls are trying to revive the long-term uptrend from the support line at 1, but certainly they would need to overcome the resistance, that's 0.2, around 133.75. That could be the key to indicate the strength of demand, and if we are going to see maybe not a resurgent dollar, but certainly a recovering dollar in the coming weeks and months. Okay, now finally, back across the pond again, and our tech stocks back in vogue. Now, we've touched on this previously. We all know tech stocks, particularly the larger ones, struggling and suffering since 2021. And that was despite their positioning that you would have thought would have benefited from, the lockdowns, the fact that a lot of them are internet-based, internet shopping, everybody being online, etc. But the downturn in 2022 was surprising and long-lasting. Now there appears to be a bit of a rally. When we spoke about the dollar index and its poor performance in Q1 earlier, pointed out at the end that it's not all negative because we saw an increase in the major tech-led indices over in the States. The last 30 days, the S&P 500 has risen from 3861 to 4090. These are figures from just earlier this week, with NASDAQ listed stocks contributing heavily to that rise. The sentiment is there that this may well continue. US inflation certainly seems to be slowing at a better rate than pretty much anywhere else, and it's certainly more stable than the UK and the EU and most Western economies. Now, the Fed is also beginning to indicate it's more likely to not increase interest rates further. Obviously, US unemployment figures, we said, may well have an impact on that. But there certainly seems to be a little bit of build-up of expectation that those rates may well remain the same for a while, or certainly we're not going to be looking at the hikes that we have seen. Now, the cost of repaying finance clearly curbed spending and growth with these interest rate hikes that we saw throughout the last 12 months or so. So if these are to slow down or even potentially look further down the line towards rate cuts, unlikely I would suggest, but people are talking about it. That could be the light at the end of the tunnel for growth. So the NASDAQ up over 14% in Q1 of this year. The S&P up 7% in the same period. So the dollar index a bit gloomy, but certainly the NASDAQ and the S&P seem to be doing pretty well, led, of course, by the tech stocks. Now, if the Fed does declare the end of interest rate increases, that could well spur on further rallies for these stocks. But of course, there's an awful lot of input for the Fed to make those type of decisions, and nothing is set in stone, that is for sure. Could be a little bit of volatility ahead for us. Certainly, keep your ears and eyes open. We wish you luck with your trading in the week ahead.